Yum Brands just sold off half a century of fast food history for $2.7 billion, just so they could immediately turn around and trigger a massive $4 billion stock buyback. We're talking about a complete global divestment of Pizza Hut, and they did it to fund their own future. But here's the crazy part. $4 billion. That is a staggering amount of capital to deploy. But while management is orchestrating this massive, highly accretive buyback to reward long-term shareholders, the broader market, well, the market is completely panicking over a lettuce supply issue at Taco Bell. It is a classic Wall Street valuation disconnect. The headlines are screaming about a short-term crisis, and they are completely missing the radical structural transformation happening right underneath. To understand why a company dumps a legacy brand like Pizza Hut, you just have to look at where Yum actually makes its money today. As of Q2 2026, KFC is the undisputed global heavyweight. It brings in nearly 52% of Yum's operating profit. Then you have Taco Bell, the domestic cash cow, sitting at roughly 39%. And then there's Pizza Hut, lagging way behind at a mere 8.8%. Over the last decade, Pizza Hut has just struggled to adapt its old dine-in format to the modern digital delivery era, losing serious ground to competitors like Domino's. So, cutting out that lagging 8.8% slice, it makes ruthless strategic sense. You remove a lower margin drag, and you instantly free up capital for your heavy hitters.
But here's the secret. The real economic engine driving Yum Brands isn't actually chicken, and it's not tacos. It's software. Specifically, a proprietary AI and digital ordering platform called Byte by Yum. You see, Yum is an incredibly asset-light business. About 97% of their physical stores are actually owned and operated by independent franchisees. Yum is the franchisor. They just collect the royalty fees. So to keep those franchisees locked in and highly profitable, Yum provides this massive end-to-end tech stack. We're talking everything from mobile apps to automated kitchen labor scheduling.
This digital bundle is what builds their true competitive moat. In 2025 alone, they processed over 370 million digital transactions. And that massive data pipeline feeds directly into machine learning models that optimize labor and slash food waste right at the store level. If you're a franchisee, this tech literally protects your operating margins against wage inflation. But more importantly for investors, it creates incredibly high switching costs. You can't just easily leave the Yum ecosystem without ripping out the very software that runs your kitchens. All of this positions them perfectly to capture a global quick-service restaurant market that's projected to hit $2.5 trillion by 2035.
Now, here is the core conflict driving the current valuation disconnect we talked about. On one hand, you have incredible long-term strength. In Q2, Taco Bell US expanded its company-owned restaurant margins by 170 basis points year over year. That is massive pricing power and labor optimization at work. But on the other hand, you have the exact reason the stock has faced so much recent pressure, a severe cyclospora outbreak linked to Taylor Farms in Mexico iceberg lettuce served at Taco Bell. This food safety crisis was so bad it forced management to cut Q3 corporate margin guidance down to a range of 19 to 21%.
And we need to be crystal clear about the severity of this issue. We're looking at over 10,930 confirmed infections, 454 hospitalizations, and 2 tragic deaths reported in Michigan by the CDC. Obviously, the tainted lettuce was pulled from the supply chain, but the brand damage is real. It's already led to a 2% decline in U.S. same-store sales for the third quarter. The market is seriously spooked by the legal liabilities, which includes a $25 million federal product liability lawsuit, and of course the immediate drop in foot traffic.
So how is this tension actually showing up in the numbers? Let's dig into the hard financial evidence from their Q2 2026 earnings, reported on July 30th, 2026, to separate the narrative from the reality. And by the way, if you like deep, evidence-based stock breakdowns like this, make sure you're subscribed. Looking at the actuals versus Wall Street consensus, it was a decidedly mixed quarter. Total revenue came in at $2.169 billion. Now that is up 12.2% year over year, but it actually missed consensus estimates by about 1%, mostly due to slower international franchise fee collection and some foreign exchange headwinds. However, their pricing power definitely shone through on the bottom line. Non-GAAP adjusted earnings per share hit 1.62, which beat estimates by about 3 cents. But look closely at that bottom row. Free cash flow came in at $407 million, which missed estimates by nearly 26%. Why? Because management is aggressively accelerating their capital expenditures on that digital and AI platform we just talked about. They are spending heavy on tech today to secure the moat tomorrow. I also really need to point out a massive gap distortion from the quarter. If you just glanced at the headlines, you might have seen their GAAP EPS jumped an insane 131% to 3.08. Do not be fooled by that top-line number. That was artificially inflated by $359 million net deferred tax benefit, which resulted directly from the IP reorganizations ahead of the planned Pizza Hut sale. That adjusted 1.62 I mentioned, that is the real operational number you need to focus on.
Okay, let's shift gears to the underlying health of the enterprise. We've synthesized a qualitative scorecard for Yum's business quality, giving it a strong blended score of 8.0 out of 10. But to be honest, the overall score isn't the real story here.
The real story is the massive contrast between their operational pillars. On the revenue side, the quality is a stellar 9 out of 10. That 97% franchised, asset-light model means they collect a steady royalty stream that is heavily insulated from store-level labor and food inflation. It is an incredibly predictable cash machine. But look at the other side. Financial health scores a mediocre 5 out of 10. Yum is carrying a heavy $12.28 billion gross debt load, pushing their net debt to EBITDA ratio to 4.43 times. That is significantly higher than the average consumer discretionary company, and it really limits their financial flexibility, especially in a higher interest rate environment.
Another key category you have to watch is management alignment, which sits at a 7 out of 10. Now, the good news is executives are compensated based on long-term operating profit growth. The bad news? Total insider ownership is incredibly low at just 0.14%, and even more concerning, we are seeing key insiders cashing out right as the strategic turnaround begins. The CEO of the Taco Bell division recently sold 3,000 shares, and a key VP dumped $1.2 million in equity over the past 12 months. Listen, when the people running the divisions are selling rather than buying the dip, investors need to pay attention.
Quick pause here because all of the research behind this video was created using Flash by StockSentinel.ai. You can generate deep research reports like this one for any public company in the world, completely free at flash.stocksentinel.ai. The core company research is free. If you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every week, it surfaces the highest conviction ideas across 3 investor styles: long-term compounders for quality businesses built to compound for years, hidden gems for under-the-radar names with asymmetric upside, and dividend hunters for durable income with the fundamentals to back it up. Portfolio Watch monitors your portfolio and flags important changes. Insider IQ tracks meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of this video. Scan it to download the Flash app and try it yourself, or access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases.
All right, let's run the numbers and look at where this stock could go over the next 5 years. Before we dive in, I need to state clearly, this is a hypothetical framework for thinking about possible outcomes. It is not a prediction, and it is not financial advice. The stock could go much higher or much lower than any of these scenarios.
Here is the 5-year valuation matrix, projecting out to 2031 from the current price of $152.99. We're modeling 3 scenarios here: a high case at a 25% probability, a base case at 55%, and a low case at 20%. If you do the math and probability weight these 3 outcomes, you arrive at a blended fair value target price of $228.06. But, as we know, a target price is useless if you don't understand the operational assumptions required to actually get there. So let's break down exactly what has to happen for each of these cases to become reality. Oh, and if you want to access the full model with all the detailed assumptions for each scenario, you can check out the detailed research report at flash.stocksentinel.ai.
Starting with the base case, which is our most likely scenario at 55%. Operationally, this assumes KFC continues its steady expansion into emerging markets and Taco Bell's domestic traffic manages to recover from the current food safety scare. In this scenario, revenue grows at a 7% compound annual growth rate, hitting $10.52 billion in year 5. With Pizza Hut gone, margins stabilize at a healthy 34%. Add in the share buybacks, reducing the float by 1.5% annually, apply 22 times multiple, and you get an implied target price of $220.51. Factoring in dividends, that's a solid 9.24% annualized return, which we treat as a very realistic baseline expectation.
But what if everything goes right?
In the high case, which we assigned a 25% probability, the Byte by Yum AI platform drives massive operating leverage at the store level. This pushes corporate margins up to 37%. At the same time, that $4 billion buyback accelerates, reducing shares outstanding by 2.5% a year. The market rewards this highly profitable, tech-driven franchise model with multiple expansion, pushing the PE multiple to 25 times. This yields an implied price of $329.56, an incredible near 18% annualized return.
Conversely, we absolutely have to look at the low case, modeled at a 20% probability. What has to happen for the stock to sink? Operationally, this assumes the cyclospora fallout permanently damages Taco Bell's brand equity, leading to prolonged traffic drops. Combine that with macroeconomic pressure, where low-income consumers pull back, and inflation compresses operating margins down to 30%. Debt service costs bite hard, share buybacks slow to a crawl, and the multiple contracts to 18 times. This paints a pretty grim picture, dropping the share price to $121.94, resulting in a negative 1.8% annualized return.
So what could actually break this long-term investment thesis? Because while the market's panic over lettuce might seem a bit short-sighted, there are very real structural risks you absolutely must monitor.
Here are the core execution risks. First, the Pizza Hut divestiture isn't just a clean, easy break. Yum still has to supply tech and transition services to the new owners, long-range capital. Any friction there could spike corporate overhead. Second, the fast food value wars are completely brutal right now. McDonald's and Wendy's are flooding the zone with $5 meal deals. If Yum has to slash prices to defend their market share, their margins will compress. Third, obviously, is that Taco Bell traffic drop dragging on longer than anticipated. And finally, that massive $12.28 billion debt load. If interest rates stay higher for longer, servicing that debt restricts the cash flow that could otherwise be going toward growth.
Which brings us to the ultimate risk question. Will this $4 billion buyback end up straining corporate liquidity if Taco Bell's domestic cash engine stalls out? Management is betting big that the food safety scare is just a temporary blip, allowing them to confidently spend billions buying up their own stock. But if that U.S. traffic fails to recover quickly, utilizing cash for buybacks instead of debt reduction could severely stretch their balance sheet.
So let's bring this all together. We started by looking at a massive valuation disconnect. The market is hyper-focused on a short-term crisis, while management is pulling the trigger on a multi-billion-dollar structural pivot. So what is the final verdict? Here are your 3 key takeaways from this explainer. Number 1, the $2.7 billion Pizza Hut exit is a masterstroke of addition by subtraction. It instantly funds a massive $4 billion share buyback that will compound earnings per share for the remaining investors. Number 2, the company's real competitive advantage isn't the food, it's the Byte by Yum tech stack that locks in franchisees and heavily protects operating margins. And number 3, despite the brilliant long-term setup, Taco Bell's domestic traffic recovery from the cyclospora outbreak is the ultimate near-term linchpin. If they can't get customers back in the door quickly, the math on the buyback and the debt load gets very, very tight.
Which leaves us with this final thought. Is Yum Brands selling its past to buy back its future? The evidence strongly suggests yes. They amputated a legacy brand to double down on an asset-light, AI-driven future for KFC and Taco Bell. If you want the full research, including the deeper framework behind this video, you can get it free at flash.stocksentinel.ai. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.